So the market's seeing a little bump starting off this shortened trading week as Wall Street banks on signs that the Fed is done hiking rates. So enter President and CEO of the Richmond Federal Reserve, Thomas Barkin. He's a voting member set to set monetary policy next year. So first, thanks for joining me. Secondly, the market says the Fed's done hiking this year and believe we could see a 100 basis point cut next year. Where do you stand?
Well, I don't think this is a big time for forward guidance on rates. I'm reacting to inflation. And if inflation ticks up, that makes the case to do more. If inflation comes down naturally, that doesn't. And so we'll see what happens to inflation. So do you believe that we're seeing more than inflation come down naturally? I mean, PCE inflation, your favorite rate, is at 3.7% for core and 3.2% or 3.4%. Is that slowing that you would like to see? Is that it? Yeah, the overall and the core numbers are both coming down nicely. Now, if you look underneath them, what you'll see is a lot of it is goods coming down at a time when rents and services are still up. And some of that's payback from the increases we saw during the pandemic era. I'm out in the market all the time. Edward, you've been out with me. And I like to do a little exercise where I ask a group of small businesses at a Chamber of Commerce meeting, what are you doing with prices going forward? And we're still in a place where half of them are at least telling me that they're taking prices up at higher than pre-COVID levels. We'll see if that actually happens. But that's still what I'm hearing on the ground. So the Fed chairman has said that rates will be higher for longer, regardless of another rate hike or not. How long, in your mind, is higher for longer then? Oh, gosh, it depends on, how the economy evolves, and in particular, demand and inflation. And so certainly I don't have an objective that looks like have interest rates be up or down. My objective is maximum employment and stable prices. And so, I'm focusing on getting prices back to the 2% target. And if you can get convinced that that's where we're headed, then that takes the pressure off of rates. But in my mind, it doesn't start with rates. It starts with inflation. So what are those markers for you then? Is there a number on inflation it has to be? Is there a number on the unemployment rate where it has to be? What are those markers? Well, I think inflation convincingly coming back to target, that's my marker. And you can get there a lot of different ways. But I'm still looking to be convinced that price setters in this economy have gotten back to where they were 3 or 4 years ago, which was an understanding that above normal price increases just weren't a management lever. So why doesn't the market then believe the Fed when they say, higher for longer and you're going to tackle inflation? The market seems to believe, not only are you done this year, but there will be cuts next year. So is there a problem with what's the disconnect? Is it forward guidance problem? Why isn't the market believing what they're hearing? Well, we've been having this conversation now for well over a year. Markets have been pricing in rate cuts faster than a lot of the forecasts in the Fed. I prefer to think of it as different forecasts on the economy. And if you're more optimistic on inflation than I am, or you're more pessimistic, on the core economy, maybe that leads you to a different path. I can just tell you what I think, which is I see inflation being stubborner, and that makes the case for me for being higher for longer. But other participants in the market have different forecasts. So this isn't the market leading the Fed. You guys would still raise rates, or you would vote still for a rate increase should you see it in the data, regardless of the volatility that it would cause? Well, you're assuming at that point that markets wouldn't see the same data that I'm seeing. So I think by the time you get to that point, a lot of data will come in. Even before the next meeting, we're going to get a whole nother round of basically all the data we get. So the data comes in, we adjust, markets adjust. That's what you've seen happen in 2023, and I presume that's what you'll see happen in 2024 as well. Yeah, President Barkin, you recently said that the UAW agreement could cause another round of labor cost pressure. First of all, what was the first round that you saw, and are you worried that this is a wage price spike that we're starting to see? Well, I wouldn't get carried away characterizing it. What I'd say is we saw all of the wage pressures that came during the shortages of the pandemic. Where we are today is professionals. It feels very much like the economy we had before COVID. You've had layoffs in a lot of support and overhead functions, big tech companies and the like. The skilled trades, that's really still where you're seeing a lot of wage pressure. And so in the aftermath of the UAW settlement,
I'm hearing people say, of course, they're having to face questions of, is this going to happen in my shop too? And we'll see where that lays out. But obviously, people do look at other companies when they're looking at wages. They also look at prices when they're looking at wages, and we'll see where it comes out. I'm not seeing big following at scale yet. I'm just saying that's something to keep an eye on.
I know you have somewhere to be, but let me ask you this: have we hit that soft landing? Do you think they've nailed it, or are we not quite there yet?
Well, it's bad karma to try to get out too far in front of yourself. I do think the data has come out in a very nice way over the last several months. The economy is still growing. Unemployment is still at 3.9%. And as you showed a little bit ago, inflation does seem to be settling. So all that's good. But the job's not done. And so you have to keep on until you get the job done. And we'll see where we land.
In 30 seconds or less, so the stronger GDP, does that give you pause at all about going forward?
Well, the numbers are remarkable in the third quarter. But on the ground, I'm not hearing that kind of frothiness. And I've said this publicly, of course. What I'm hearing is a normalizing economy. And a good way to look at it is year over year consumer spending growth, year over year retail sales. Those numbers look much more like trend numbers than they do like the frothy numbers you would see in the third quarter. And so I'm just assuming those third quarter numbers are payback for a weak spring. And so I'm expecting a much more normal set of growth numbers going forward, certainly not what we saw in the third quarter.
President Thomas Barkin, thank you very much for your time. I really appreciate it. Your insights, obviously spot on, a very important voice in the markets. Thank you for your time.
Thanks, Edward.